Here's a strategy used by wealthy investors and financial advisors that most everyday investors have never heard of, and it could save you hundreds or even thousands of dollars in taxes every year. It's called tax loss harvesting. And despite the name, it's not complicated. In this video, I'm going to explain exactly what tax loss harvesting is, how it works, when you should use it, and the pitfalls that trip people up. By the end, you'll understand whether this strategy applies to you, and if it does, how to use it. Let's start from the beginning. When you sell an investment for more than you paid for it, you have a capital gain, and you owe taxes on that gain. When you sell an investment for less than you paid for it, you have a capital loss. Tax loss harvesting is the practice of intentionally selling investments at a loss to offset capital gains and reduce your overall tax bill. Here's a simple example. Say you have two investments, stock A, which you bought for $5,000 and is now worth $8,000. That's a $3,000 gain. And stock B, which you bought for $4,000 and is now worth $2,500. That's a $1,500 loss. If you sell both, your net capital gain is $1,500, the $3,000 gain minus the $1,500 loss. You only pay taxes on $1,500 instead of the full $3,000. That's tax loss harvesting in action. But what if you have more losses than gains? This is where it gets even more useful. The IRS allows you to use capital losses to offset ordinary income, up to $3,000 per year. So if you have $5,000 in losses and zero capital gains, you can deduct $3,000 from your regular income this year, potentially saving you $660 to $1,110 in taxes depending on your tax bracket. The remaining $2,000 in losses carries forward to future years, where it can offset future gains or reduce income again. There's no expiration on these carry-forward losses, they stick with you until you use them up. Now, the natural question is, if I sell my losing investments, don't I lose the chance to recover when they bounce back? This is where the replacement strategy comes in. You can immediately reinvest the proceeds from your losing investment into a similar, but not identical, investment. This keeps your market exposure essentially the same while locking in the tax loss on paper. For example, if you sell shares of the Vanguard S&P 500 ETF, VOO, at a loss, you could immediately buy the iShares S&P 500 ETF, IVV, which tracks the same index but is technically a different security. Your portfolio stays invested in large-cap U.S. stocks, but you've harvested a tax loss. Here's the critical rule you must understand, the wash sale rule. The IRS says you cannot claim a loss if you buy a substantially identical security within 30 days before or after the sale, a 61-day window total. If you sell VOO at a loss and buy VOO back the next day, the IRS disallows the loss. This is a wash sale. The disallowed loss isn't gone forever, it gets added to the cost basis of the new shares, but you lose the immediate tax benefit. To avoid a wash sale, you need to buy something similar but not identical. Different ETFs tracking similar but not identical indexes generally pass this test. When in doubt, consult a tax professional, because the definition of substantially identical has nuances. Let's talk about when tax loss harvesting makes the most sense. First, it only applies to taxable brokerage accounts, not IRAs, 401(k), S, or HSAs. In those accounts, you don't pay taxes on gains anyway, so there's nothing to offset. Second, it's most valuable to people in higher tax brackets. If you're in the 15% long-term capital gains bracket, the savings are modest. If you're in the 20% bracket plus the 3.8% net investment income tax, saving $3,000 in recognized gains could be worth nearly $700. Third, it's most useful in years when you have significant capital gains to offset, perhaps from selling a business, selling other investments, or receiving large distributions from mutual funds. One common scenario where tax loss harvesting is immediately relevant, at the end of a down year in the market. When markets fall, like they did in 2022, investors who haven't sold anything still hold unrealized losses on paper. Tax loss harvesting lets you turn those paper losses into real tax savings, while staying invested in the market through equivalent replacement securities. You're not market timing. You're just optimizing the tax treatment of what you already own. Let me talk about robo-advisors and automated tax loss harvesting, because this has become widely available and changes the math significantly. Platforms like Betterment, Wealthfront, and Schwab Intelligent Portfolios offer automated tax loss harvesting. They monitor your portfolio daily and harvest losses automatically when opportunities arise, while managing wash-sale compliance across your accounts. For investors with significant taxable portfolios, generally $100,000 or more, these platforms can generate meaningful tax savings that more than cover their fees. For smaller portfolios, the benefit is less dramatic, but it's still free on some platforms. A few important caveats. Tax loss harvesting is a deferral strategy, not elimination. When you harvest a loss and buy a replacement security, your cost basis in the new security is lower than it would have been. This means when you eventually sell the new security, your gain will be larger. You're not eliminating taxes, you're pushing them into the future, which is still valuable because of the time value of money, but it's important to understand this. Additionally, short-term capital gains, from investments held less than a year, are taxed at ordinary income rates, up to 37%. Long-term gains, held more than a year, are taxed at lower rates, 0, 15, or 20%. When harvesting losses, it's best to prioritize offsetting short-term gains first, since those are taxed at higher rates. Let me give you a practical action plan for beginners. Step 1. Determine whether this applies to you. Do you have a taxable brokerage account? Have you had capital gains this year, or do you expect some? Are you in a tax bracket where this creates meaningful savings? If yes to these, continue. Step 2. Review your portfolio for positions currently showing losses. Step 3. Identify a suitable replacement investment, same asset class, different security, more than 30 days separation from any recent purchase of the same security. Step 4. Sell the losing position and immediately buy the replacement. Step 5. Document everything. Save records of what you sold, the loss amount, what you bought as a replacement, and the date. Your tax software or accountant will need this. What if you're a complete beginner with a small account? The honest answer is that tax loss harvesting has limited benefit for small portfolios. If your total investments are under $20,000, the tax savings from harvesting losses might be a few $100s at most, worth knowing about, but not a game changer. Focus first on maximizing your tax-advantaged accounts, 401k, IRA, HSA. Once you have significant assets in a taxable account, tax loss harvesting becomes meaningfully valuable. Think of it as a strategy that grows in importance alongside your portfolio. To recap, tax loss harvesting means selling investments at a loss to offset gains or ordinary income, reducing your tax bill. The key rules are: only works in taxable accounts, watch out for the wash sale rule, use similar but not identical replacement securities, and it's most valuable in higher tax brackets or high gain years. It's not magic. It's a legitimate, IRS-approved strategy that sophisticated investors use to keep more of what they earn. Start small, stay organized, and let it become a natural part of your year-end investment review. Subscribe for more content like this, and I'll see you in the next video.